Okay, welcome everybody to today's webinar. Div 296, self-managed super funds, the good, the bad, and the ugly. Look, I like to roll that title out every so often for a webinar, um, and still really ultimately deciphering what the bad and the ugly are with regards to Div 296 and whether there is any good. But of course, this is a process that we've been through for a couple of years now, three in total if we talk about when it was introduced, first announced back in February 2023. So let's jump into it, and I'm sure along the way you might have some questions that you want to ask me. Never more relevant is my disclaimer about the reliability of the information. To be clear on this, the legislation landed yesterday. So we had the exposure draft in December, but we actually got the legislation yesterday. So I have been sort of burrowing as deep into that as I can and extracting enough information that I hope from both the consultation period and the what we saw come out yesterday to be able to deliver in an hour. And I was just having a chat before with Josh and with regards to SuperGuardian, whether we look to run another Div 296 one, perhaps in lieu of the regulations being released, because there's still a lot of content to come out there. But running it over two sessions is probably not necessarily a bad idea. So what I want to focus on today is a little bit of identification of the differences. I don't want to go back too far, but I just want to highlight some of the key differences between the old Div 296 and the and what has now been released and introduced into Parliament there, and really focus on, I guess, some of the key issues that we see, and not just when I say we, I mean we collectively as an industry. You'll see here from my timetable that I've put together, going back all the way to Feb 2023. For those that have been attending these SuperGuardian webinars for the last few years since I sort of started delivering them on behalf of SuperGuardian from my position at Smarter SMSF, I was involved in that initial roundtable. I don't like to call it consultation with Treasury because it didn't feel like there was much consultation in regards to that piece, but certainly we took a fairly hands-on approach to this Div 296 stuff, and you'll see there post-December that I was also involved, the SMSF Association, who have been part of the process with Treasury on this. I was again involved in a roundtable with some key industry peers of mine, and so it was always good to get together with that group, many of them presenters as well, to talk about what we like, what we don't like, what we can potentially get changed. Answer to that is nothing, but in essence, it gives us a bit of an overview of what we can sort of work towards when dealing with our clients. But the key to all of this is that as of yesterday, we have seen the introduction of what is now to be known as the Treasury Laws Amendment, Building a Stronger and Fairer Super System, Bill 2026. Now, it wouldn't be fair to talk about Div 296 without discussing the fairer element of that piece of legislation, and that is the low income tax offset. So we know from October last year when the government sort of reformed their position on Div 296 and said that we've listened to consultation, we got to a position where they said we are going to reintroduce it, and we'll go through all of the elements of that shortly, obviously. But what we're also going to do is we are going to update the low income super tax offset to align it with the tax-free stage cuts that came in 2021, 22, whatever that year was. I think from 1 July 2021, I can't quite remember. Align it with those tax changes and the threshold changes, where we saw the low threshold jump up and the low rate drop down to 14% or whatever it is, but also or inevitably 14%, but also we saw the threshold jump from 37 to 45,000. And so what we saw, and also the fact that the old Listo was based on 9% super guarantee and SG is now 12%. So an interesting measure, and for me, a late measure. It's a scenario where I think this is great, this low income super tax offset, and I think it's finally a situation that they have provided the necessary update for it. Um, However, it is a couple of years late. But what we see is that the low income tax offset will now apply up to the higher end of the low threshold, so $45,000. So that from 21 July 2027, when this comes into effect, that'll be the number, but that number will change. Okay, so if we see changes to the tax tables, to the thresholds, then that income threshold will, based on the way the legislation's written, be moving in alignment with that. The minimum or the maximum tax offset will also effectively be an evolving number, and it will be representative of 15% of the super guarantee levy, so the 12% at this point in time on that 45,000. So whatever when you do the maths, 45 times 12%, times 15%, that's where you get to 810. So ultimately, it will move with alignment rather than being a fixed number as it was under the $37,000. So this is a really positive measure in the sense of what we've seen from a tax point of view. It will result in obviously more people being eligible. Where they currently sit, particularly you look at the example there of Stuart and Iris, where they wouldn't be eligible for it, then they will be eligible for a full tax offset on their employer contributions or their deductible contributions moving forward. So good measure. Also, for me, makes it difficult when we're starting to deal with things such as the better targeted super concessions and the $3 million threshold. Certainly, it's a typical move by any government looking to introduce legislation of let's classify it of targeting certain taxpayers. If you then also introduce a measure at the same time that targets the other end of the tax scale, then it makes it a little bit harder for those in Parliament to sort of talk these measures down and say, well, we're opposed to the overall reform package. It's like, okay, so you're opposed to supporting the low income earners, and so it's typical politics in that regard. How much influence the Listo stuff will sway the opposition and the Greens and other parties, I'm not sure. Let's be honest, the government control the House, so getting the measures through the House is certainly not a problem. And ultimately, the Senate is going to come down almost exclusively to the Greens in this regard. So there's enough there within the Greens for them to get the measure through. We know through what we read and what we hear that the Greens aren't necessarily happy with all the changes that have been made, particularly around, say, the unrealised losses being removed from the calculation. They obviously also pushed for a $2 million threshold previously, but we've got to also remember that they got their paid paternity leave and super guarantee elements. Or paternity leave. They got all of that included to vote for it the first time around. So it would appear, and I sort of say that hesitantly, that there is a clearer passage for the government to get this reform through. But we did say that probably in 2023, 2024, and maybe the start of 2025 before it all sort of, or maybe not the start of 2025, but before it all sort of went pear-shaped and many senators sort of pushed back against the unrealised CGT piece. So where are we at? How did we get to where we are now? 13th of October, we saw the government release their better targeted super concessions launch a few fact sheets about it, and they said they were reintroducing the Div 296, and they're still targeting those members with the larger balances there, those with more than $3 million, but they had made changes in response to stakeholder feedback and fairness, which code for they didn't get their other measures through. So if they wanted to bring something in, they had to listen to somebody, and they clearly did. And the key issues that the industry addressed in the previous incarnation of Div 296 were ultimately rectified. So what we actually saw was our threshold going from $3 million non-indexed to $3 million large superannuation balance, and then a new one, a $10 million, very very targeted from a name point of view. I love this one. Instead of having a large superannuation balance, we've also now got a very large superannuation balance. So, that's it's legislated that the word "very" is in there, and they're both indexed, and they're both indexed in line with CPI. And I'm going to touch on that a little bit in a moment's time about what that actually means for us. So we've got the indexation threshold that was ticking one of the boxes of what the industry was after before. The earnings base was, of course, the biggest issue of all. So previously, we had a tax based on unrealized capital gains, so a movement from start of year to end of year in an individual's total superannuation balance. And that was the inequity in the measure. So it was never that there was significant opposition to the implementation of a Division 296 tax. It was that we were taxing something that was effectively a paper figure. So it wasn't based on real earnings. It was based on market position at the end of financial year, and that was problematic for multiple reasons, but one of them being liquidity, right? So the fact is, if you've got unrealized gains, then the funds or the individual doesn't necessarily have the liquidity to pay the liability, and whilst they built in mechanisms to accommodate that, with regards to the timeframes for paying Div 296 liability, it was a real sticking point from an industry point. So where are we now? We are now at a realised or a real earnings approach, which will align it with existing income tax calculation measures. And so it's effectively the classical utilising the super fund's position to determine the individual's tax liability. And I might say this a couple of times through the webinar today, but I think it's really important that we go back and revisit one of the key issues from before, and that is that this is not a super fund tax, right? This is a tax on the individual, right? It is driven by the earnings attributable to that individual in the superannuation system, but it is not a liability for the superannuation fund. So we have a tax that can be paid out of the super fund, but it is a tax on the individual. Because we've now got this very large super balance of 10 millions, we have two effectively tax tiers. We've got the additional 15%, so those people paying an additional 15% tax or paying 15% tax. We shouldn't say an additional 15 because you might be in ECPI and not paying any tax on the earnings, but paying 15% tax on the earnings attributable above 3 million, between 3 million and 10, and then a further 10% on the earnings attributable above that $10 million. So maximum rate, which is to me a slight misrepresentation, but to be able to use it to highlight a 30 and 40% tax rate. Start date, obviously we couldn't start last year because we didn't have any legislation. So we've got a movement to the 1st of July this year. Exclusions, and this is an important area to understand, is that primarily the exclusions haven't changed, with the exception of the death of a member, right? So previously, if somebody died during the year on any day other than the 30th of June, then they were excluded from Division 296. That is not the case moving forward. So yes, there's an exception for our child recipients of income streams. There's an exception for structured settlement contributions, but individuals who pass away will still be liable for Division 296. And I'm going to spend a bit of time talking about that through today's webinar. The key is, if they die during the first year at any point in time, then they're not liable. So anyone that passes away in the 26-27 financial year, they won't be liable for Div 296, but anyone that passes away following 1 July 2027, then they will be liable for Division 296. So that's a fundamental change that we have to prepare for and work through with our clients in this space. And as I said, there's some key issues. One of the tables that I want to run you through towards the end of the webinar is really focusing on where there are still some I can say it will suggest considered discrepancies with it. Whether we ever see any changes in that place, obviously from consultation, we're not seeing any changes, but whether there is any movement in this area, either through the regulations or later, time will tell. But now they're the pain points that we have to understand exist, and we have to be able to represent those pain points to our clients that are going to be impacted for it. So again, reiterating the point, this is not a change to the way super funds are taxed. Right? It's not a change to the way super funds prepare their annual return. However, if you get into the detail of this legislation, what it means for anybody that is preparing superannuation funds from a tax lodgement point of view. So anyone that is determining the earnings for an annual return purpose, this is going to result in additional working requirements, right? Around exempt current pension income, around capital gains and other elements. And I'll touch on that from a process point of view as we go through today. Appreciating that today is very much at high level because there is so much to talk about, and then we look to break these things down, as we get clear understanding of things. So no difference from a fund point of view. Big differences for admin of funds because of what the record keeping that we might have to undertake, and additional processes that we might need to do following the release of the regulations, but nothing else from the fund's actual tax position. It is ultimately all coming down to the member, as I highlighted before. So the key around these thresholds, as was highlighted in the key changes, was that we've now got indexed amounts. Now we've got our $3 million threshold, which is going to be indexed in amounts of $150,000, and we've then got our $10 million threshold, which is going to be indexed in accordance with $500,000 increments. So both utilising exactly the same formula as the general transfer balance cap, which is, the base amount, so the 3 million or the 10 million, multiplied by the current or by the December CPI figure divided by the base CPI figure. And that base CPI figure is going to be the December number from 2025. So the number just passed there for the 3 million and the 10 million. So the formula, whilst it looks the same, is going to be different to the general transfer balance cap calculation because you're using different base numbers there. When I muck around with these calculations, there's an expectation that when one goes up, the others will go up, right? But it's not guaranteed, and I haven't tested absolutely every sort of indexation type level to sort of dummy proof that answer or that comment. But what you'll note in the explanatory memorandum is that the government have said it is not 100% guaranteed that all these numbers, the general transfer balance cap, the $3 million and the 10 million, will go up at the same time. I think they will, right? But at this point in time, you've just got to assume that you've got to do three calculations for different purposes. Obviously, the general transfer balance cap is for our pensions and things, and these other two are to determine whether or not we're going to be liable for the tax. That's clunky, right? And it's made clunkier because it was really easy to sell, not to sell this, but it was really easy to discuss this when you said, well, the Div 296 threshold is 1.5 times the general transfer balance cap. So it was 2 million going up to 3 million. And then you could say then the very large super balance is 5 times the general transfer balance cap. Well, that was perfect till the general transfer balance cap was indexed or will be indexed from the 1st of July this year to $2.1 million. So our indexation figures, our CPI figures from December, mean we just get over that amount, and subject to no intervention by the government, which you can't expect that there would be, we will see a general transfer balance cap of $2.1 million from the 1st of July this year. So already we've got discrepancies in the way that those numbers are going to operate. So just important to understand that we do have moving numbers. So our thresholds are going to result in some elements moving, which is beneficial in the way that we operate. But let's have a look at the nuts and bolts stuff, because that's what people really want to know about, is how this works, who it impacts, and some of the key issues associated with it. So fundamentally, other than the earnings piece, Everything else is largely as it was under the original measure. So we've got our concept of taxable superannuation earnings. So it's the calculation of the taxable superannuation earnings that differentiates in the new model versus the old. The actual tax liability is subject to ultimately the same formula adjusted for the introduction of the $10 million. So I've got step 1, 2, 3, and step 1, 2, 3 is step 1 to 6, ultimately subject to where somebody's balance will sit. But there is one critical difference in this new measure comparative to the old measure, and it's probably the most significant change associated with this, and it will be a pain point, right? There's no doubt it's going to be a pain point. And so if I read that out there, so a person has taxable superannuation earnings for an income year if their total super balance at the end of the year or just before the start of the year is greater than the large superannuation balance threshold, 3 million, and the amount of their super earnings for the year is greater than nil, right? The key difference there, so everything about that definition is exactly the same, except the or just before the start of the year. So now what has been introduced is a mechanism to say, what is the highest balance that this person has had? Was it the balance at the start of the year, or was it the balance at the end of the year? And we're going to then use that to determine the proportion of the fund earnings that is above the threshold that will result in the applicable tax calculation. So let's take that highest number, let's subtract from that the $3 million or the $10 million, then divide by that same reference amount, right? That's going to give us a proportion of fund earnings that is applicable to Div 296, and then that proportion will result in the earnings multiplied by that proportion gives us our amount to calculate that additional 15% tax liability on. We do that for the $3 million. We then do that same calculation for the $10 million for those with the very large superannuation balance, and then we multiply that proportion by the 10% threshold. So the key to that calculation is this concept of who is an in-scope member. Now, what we had before was if your balance was below $3 million at the end of the year, you weren't in scope from a Div 296 point of view. What you were in scope for was having losses to be able to, having Div 296 losses to be able to carry them forward into the next year. That concept has disappeared. So there's no such thing as a loss for Div 296 purposes. There's effectively just the income, or there's just the tax liability on the earnings for that year, and then you effectively reset and start again the next year from a calculation point of view. But this concept of just before the start of the year and the end of the year is going to cause problems for a lot of people, and ultimately those people are going to be inclusive of people that are in drawdown phase and their balance reduces. It is going to impact people who have a significant event occur associated with fund investments, because if that event occurs late in a financial year, you're going to have that year that's triggered, and then potentially the next year that's triggered because your closing balance or your opening balance is going to still be high. And then for whatever purpose that investment tanks, or it was an overly inflated investment, or whatever the situation might be, and you never get back to that $3 million again, but your opening balance was above it, so you're going to be liable for that year. So it's effectively in certain instances going to create a 2-year liability on the income of the fund. And we can all say what we want about that, and the government will often reflect on these sorts of things based on how they see the measure operating. But if we go back to pre-February 2023, the buzz around the industry at that point in time was the government don't want people to have money, like significant money in superannuation. They don't want them to get their tax concessions. So there was all the conversation piece around if they got more than 5 million or whatever the number might have been, let's get them to rip it out. Right? And they said, okay, well, we're not going to go down that path. We're not going to tell people to take their money out of super. We're just going to impose this tax. And so the fact that we are taxing balances with a diminishing value, so people whose money is going down because they are actually pulling money out of the superannuation system, just fundamentally seems wrong. That's a personal view probably shared by quite a lot of people, but I think that there's some real issues associated with that. Now, from a transitional point of view, we don't have the either or approach. So in the 26-27 year, we are operating exclusively on end of year balances. Okay, so that means because right now is what you would call not panic stations. Let's not be sort of overly dramatic about this. Now is that point in time where people go, what action do we need to take? Well, firstly, no action until there's law, right? You don't ever act before there is something to act on, right? But then it's like, well, do we need to do something before the 30th of June 2026? Short answer is no, right? Because they're operating under the premise that the first year will only be reflective of the closing balance. People have then got, if people want to get out, right? And I'm not suggesting getting out is the right objective or the right result for people, but if people want to get out of the superannuation system, then they've ultimately got until 30 June 2027 to take that action. So we don't need to jump around too much here. Now, in the submissions that were put to Treasury from pretty much everybody that I read, linked to self-managed super, I didn't read all of the submissions out there. There were many different options that were put together, but they've all been denied, and they've stuck true with this opening and closing balance. One of the key changes. So there was one slight change in regards to this opening and closing, and that was that in the exposure draft, when they talked about the death of the member in year one, they had their reference back to that old, anyone that dies prior to the last day of the financial year. So effectively saying if you died on the 30th of June, you would still be liable. And that captured everyone's imagination last time around. And so it was in the exposure draft, didn't get a lot of focus, but it was kind of like, well, that sticking point is still there. In the bill that was released yesterday, if the person dies at any time in that first financial year, they will not be liable for Division 296. So anybody that dies in the 26-27 year with a balance above the $3 million will not be liable for Div 296. The other key difference is that what they have introduced from a death benefit point of view is when you die, your total super balance dies with you, right? So for deceased members, they're only going to be liable for Division 296 up to and including the year that they pass away, right? So opening balance will be relevant in that year, but for the following years, and we know it's the case. Anyone that's had anything to do with death benefits in an SMSF know that it's very rare, or maybe not very rare, but it's not uncommon. Let me put it that way. It's not uncommon for death benefits to straddle financial years, right? So proceeds to be sitting inside of the fund longer than one financial year before it's paid out. Div 296 does not force the payment to be made in the first year, right? So it does not create an issue in that instance. And this is going to create the same conversations around reversionary versus non-reversionary pensions that the initial Div 296 stuff had on it, because with a reversionary pension, right, the deceased TSB disappears, but the reversionary's total super balance at the end of year one will be impacted, right? So what it actually means is that in those situations where there is a reversionary pension in place, we've got 12 months to act from a transfer balance cap point of view and transfer balance account point of view, but we've got zero time to act from a Div 296, and individuals in a reversionary pension could be hit from year one. Now that is a marked difference from the original piece as well. So we have to review our pension strategies once this legislation comes in, because again, from a discretionary point of view, if there's discretion as to what to do, then that money, the total super balance of the deceased disappears, even if their balance doesn't. their surviving spouse, for example, just goes along with their own balance in year one, and it's not until that money is potentially paid into a new death benefit income stream, and it might only be reflected at the end of the following year. So you're going to get that potential for deferral under non-reversionary pensions as well. So there's a lot to play out in that space. So there will be adjustments with regards to total super balance as well, and I think it's important that we work through some of those key issues. This was always the good part of the original legislation that was introduced, was the reflection on total super balance and the link between total super balance and transfer balance cap, and removing that link and basically moving it to this concept of withdrawal benefit. And so again, we've effectively seen almost a cleansing of the definition of total super balance to say your total super balance is for your accumulation-based funds, which is majority of self-managed superannuation funds, bar a few thousand that still have defined benefit funds. For the majority of us, it is just the amount of money that you would have had you closed the fund at the previous 30 June, right? So total super balance is going to be based on withdrawal balance. That's promising. That's going to be a measure for even to do with contributions and other things moving forward. So there's a positive element to come out of this in that we lose that stupid modified transfer balance cap calculation for total super balance purposes. Further, as was previously in the measures, limited recourse borrowing arrangements, because we're talking about the earnings on the net position of the fund here, limited recourse borrowing arrangements are effectively stripped out of the total super balance calc for the purposes of Div 296. For contribution purposes, they're still included. But here we're talking purely on the earnings, so we remove them out. So we get that change of total super balance definition that we were hoping would come in with the last measure. That's a positive. Interesting. I'm not sure really. I don't know why this is in there. I mean, maybe it's just I read too much legislation, but they really put an emphasis to say that the total super balance excludes interest in foreign superannuation funds. Never did in the past either, so I'm not sure why we focus too much on that. But I thought I'd just highlight it that it's really sort of gone to the point about foreign funds to be excluded there. So that's how the tax calc's done. We take our total super balance, right, and we have our total super balance value, start year, end of year, whatever the highest, that's what we're picking it on. We then apply that to our earnings, right? This is going to be based upon our fund's taxable income with various adjustments being made. So those adjustments is you're going to take your relevant taxable income or loss. We're going to take away our assessable contributions, right? We're going to add our net ECPI. So again, net ECPI is a calculation that incorporates whatever we do from a deductibility point of view from ECPI. And there's some quirky elements here associated with the deductions that you can use to offset versus others, and how problematic that's going to be from an admin point of view. I think we'll have to wait and see exactly what that looks like. But we add back our ECPI. We take away our non-arm's length component, again, hoping that we don't have too much of a non-arm's length component. And then we add in our pooled superannuation trust component, because we know that the earnings of pooled super trust from a taxing point of view, if the fund invests in a pooled super trust, it's taxed elsewhere. It's not taxed in the super environment. So we do our calculation based on the same kind of concept that we do from a normal end of year process, right? I'm determining what the taxable position of the fund is, but now we then strip out our contributions, add in our ECPI, right? Take out our NALI, right? And then add back our pooled super trust. So for most self-managed funds that are captured under this measure, what we're really looking at is taxable income, take contributions, plus ECPI, right? And that's the simplicity of the calculation, albeit that it's not so simple with regards to ECPI when you've got segregated assets and other things like that, and what you can then count back or add back in to the calculation. So this is where, we would do our normal end of year tax calculation, where we've got clients that are in scope from a Div 296 point of view, then the funds are going to have to do an additional tax calculation on the assumption, right, that the majority of these funds, in my eyes, again, an opinion piece here, majority of these funds are going to have some pension associated with them, because a lot of these funds are largely legacy funds, funds that have been around for some period of time and have been and were captured under the old transfer, the introduction of transfer balance cap and other things as well. However, as we see the general transfer balance cap continuing to index, and again, this is where indexation has been a positive. There will still be that gap between people who can make contributions because they're at the general transfer balance cap. But then there will still be people that are captured because certain contributions, downsizer, small business concessional contributions, those sorts of contributions are not subject to total super balance. And so you will still get people who can't make non-concessional contributions but can still contribute to super that will push them towards that $3 million limit. So there's all sorts of things that will eventually result in potentially only accumulation members being impacted. But for the vast majority of initial people hit by this, it's going to be people that have legacy funds where they had unlimited ability to contribute over the last sort of 20 years or pre-2007. Okay. One of the key things is, as I said at the start, we don't have negative 296 Div 296 earnings, right? So whereas before, if we paid Div 296 and then the next year, if our balance dropped down to below 3 million, we could then calculate negative earnings, which we could then carry forward to offset against future earnings. That's gone, right? So it's effectively a fresh calculation each year. However, if we get tax losses from a pure super fund point of view, then those losses effectively are claimed and carried forward in the normal taxing sense. They will still be able to offset, obviously, the future tax position of the fund. So there is some benefit still associated with this with regards to losses overall. However, it's not really in that ECPI piece, because from an ECPI point of view, we utilize our capital losses to determine our net ECPI, right? And normally what we would do in the funds position is, if we have excess carried forward capital losses, I said that correctly, if we have excess capital losses, we would carry them forward to be able to offset against the following year, right? In this instance, to determine the net ECPI, we effectively have to do our normal CGT calculation for adding this all back in. But if we sort of have excess segregated losses, we can't carry those forward because they're ignored for the funds tax point of view. They're built back in for Div 296, but then they're ignored again for the future of the funds tax position. Now, again, I say that noting that in many instances, we're not going to have segregated investments because of the $1.6 million disregarded small fund asset piece, but it's something to certainly be mindful of. We do the calculation. Our net ECPI can be reduced by related, Div 8.1 deductions from the Tax Act, but there's other deductions that we can't actually reduce our net ECPI amount by, and these are the areas that I think that we still need to work through from an industry point of view to see what the final outcome is going to be there, or if there is ever going to be any potential change in that space, or if the regulation makes allowances for the calculations there. So we calculate the earnings, and then those earnings have to be distributed across the in-scope members on a fair and a reasonable basis, right? And the concept of fair and reasonable basis is an interesting one, because anyone that's sort of played along since Div 296 was originally announced, we know that the government, sort of one of their key elements was, we don't want to legislate differently for different parts of the sector, right? Now, all of us know that they always legislate differently for different parts of the sector. I mean, otherwise, why would we not have exceptions for constitutionally protected funds? Why would we not have exceptions for judge? Why would we not have that? So there's always certain changes or certain exceptions that apply to different parts of the industry. But what they were really always alluding to was we don't want to treat APRA funds and SMSFs any differently. And then, of course, that'll blow up when the gnarly rules came in and they legislated differently, and they brought in the general expenditure requirements for self-managed funds or small funds versus APRA funds, excluded APRA funds there. And again, they've done the same with the fair and reasonable attribution of income from a Div 296 point of view. So from a Div 296 point of view, APRA funds have to determine what is fair and reasonable across the members under certain guidelines. Self-managed super funds, or small funds, I should say, to be clear, so funds with no more than 6 members, also have to apply the attribution of income on a fair and reasonable basis via the use of an actuarial certificate, right? And so what's of interest with regards to this whole actuarial piece is, will we go down the same path that we went down when transfer balance cap came in? And in some instances, for probably 3 or 4 years, we had to get an actuarial certificate, even though 100% of the fund's assets were in pension. We used to have to get a certificate to say that 100% was in pension. And then they changed that around the deemed segregation piece and didn't require it. So what we want to hope for when we see these regulations is, if you have a single member fund with more than the $3 million, there we know that all the income is attributable to that member, and we don't need to go off and get an actuarial certificate to dictate that 100% of the income is attributable to that member. Time will tell, right? So we have to wait and see what that requirement is. But what it means is that for funds, we will need effectively 2 actuarial certificates, or at least 2 pieces to a singular actuarial certificate, right? So one bit to determine the ECPI for the fund's tax position, and another piece to determine how much of the income is attributable to in-scope members for Div 296 purposes. So you'd hope and expect that there would be some sort of synergy, and that could all be produced into one actuarial certificate. Of course, there's going to be funds that don't need an actuarial certificate for ECPI purposes, but might need it for attribution purposes, and those that need it for ECPI and don't need it for Div 296. So, what comes about from all that is clearly going to be an issue for us to be mindful of. But also, and one of the points about the whole attribution piece is, it doesn't really. And I appreciate that the government don't care about this, right? But it doesn't really factor in, say, asset segregations from an investment strategy point of view. So where you've got, and we know that from an ECPI point, the tax deduction for the fund is based on stripping back the assets and just treating them as belonging to the fund rather than individuals. But if you've got directed investment strategies in place from the fund's point of view, and you've got actual income going to that member to grow their balances, and then you're actually stripping that income out and giving it to the other member for Div 296 purposes, then you're creating anomalies with regards to what the fund is actually trying to achieve. And so funds need to start to review and consider that as they move forward, as to whether or not these specific investment strategies or these directed investment strategies are having any benefit to the fund. And I liken it a little bit, for those that have been around the industry long enough, to pre-2007 reasonable benefit limits, where you had tax outcomes, and again, it was personal tax outcomes, where you would have your growth assets inside your fully rebatable pension, and then you'd have your non-growth assets in your non-rebatable pension. And of course, that's what segregation from a tax point of view has tried to stop. And similarly, I think we're going to have some Div 296 considerations here. So the way that it's going to operate then is, we'll have the ATO will be notifying who your in-scope members are. The fund is going to calculate and report the realised earnings. Then the ATO will apply their calculations, and they will issue the Div 296 to the members, right? And then the member has a choice to pay it personally or to pay via the fund. Now, we've got an issue here, and that is that death benefits are now included in this. And so you'll hear some people talk about, it's an introduction of death tax, and to a degree it is, or introduction of a different death tax compared to some of the already existing ones there. But when you work through the mechanics of the issuing of the notices, if somebody has died, then that notice has to go to the effectively to the estate, so to the legal personal representative. So if that member has passed away, then there is no member choice as to where to pay it. The money has to come out of the estate. So the discrepancy that creates is that the super money may have been paid to one beneficiary, and the estate might be being paid to another beneficiary, and that in itself could result in problems with regards to the equalisation or whatever from an estate point of view, estate planning point of view, as to where payments are actually going to go, or who's going to receive the end benefit. And so this whole piece of legislation does introduce other things that we have to be mindful of with regards to our clients to ensure that there's no imbalance with regards to the tax payment, particularly around death. So look, let's go through couple of calculations just to show how it works, and this is just confirmation really of the process. No difference really, as I said before, to the old approach here. But then I also want to talk a little bit about the CGT piece and finish off with that before sort of creating a final summary of the problems in this space. So we've got Megan, member of the super fund, total super balance at the 1st of July 2027. So we're going with the end of year balance there of 4.5 million. Had the fund had $300,000 of realised earnings from the SMSF, which are attributed to her member balance. So the proportion of her 4.5, which is above the $3 million, is 33.33%, always rounded to two decimal places there. She's got no amount above the $10 million. So her Div 296 liability is going to be $15,000, which is 15% of 33.33% of $300,000. That's how her liability will be calculated. If we look at Emma, in this situation, got a total super balance of 12.06 million, had realised earnings of $840,000. So we have to do all six of the steps before. As I said, there's 3 steps for less than 10 million, 6 steps for more than 10 million. So 76% roughly, so 3/4 of the earnings are attributable to a balance above $3 million. And then 22% of all earnings are attributable to the balance above 10 million when we do the various formulas, meaning we've got to do the two calcs, so 15% of 76% of 840 and then a 10% of 22% of 840. So her liability is going to come out at $115,000. So as I said, that number and that calculation is in effect exactly the same as it was previously. It's how we get to that earnings piece that is different, plus we add on the $10 million as significance. So probably the last key piece of the legislation is we now know this is based on realised capital gains, right? So the key that we wanted to make sure was that we removed unrealised gains from the calculation. That request or that piece of negotiation has come into play. And what the government have indicated and what the bill provides for is that Division 296 is only payable on the gain of the asset attributable to a post 30 June 2026 gain, right? So again, what you can already start to identify here is we've got 2 CGT calculations that we're doing one for fund purposes, right? Because we don't change the cost base, we don't change the original cost base, we don't change the holding patterns. Have we held this asset longer than 12 months? We do our normal tax calculation from the fund's income tax point of view, and then we do a Div 296, which is based on the 30 June 2026 valuation. This is an all or nothing election. So unlike when transfer balance cap came in and we could actually be selective in our fund investments, this is an all or nothing election where the fund either applies a cost-based increase for Div 296 purposes across all its assets or across none of its assets, right? We've also got to do an election. That election has to be done prior to the lodgement date of the 26-27 return. So again, we don't have to make an assessment as at the 30th of June this year. We need to probably start looking at things, but we have to actually do our election, which we retain. We don't provide that election to the ATO. We don't have to send it anywhere. The fund retains it for effectively up until I think it's 5 years after the investments are actually sold. But the anomaly, the problem here is, and of course you'll note that I've made a comment there that industry has been ignored here. Our point or our pushback on this is, shouldn't it be based on like effectively the highest cost base that you can use, right? So the Div 296 point of view based on the highest cost base. So if you bought the shares for a significant amount back before 2026 and then they dipped in value and then they've recovered, then you're paying it on a higher amount. In that set of circumstances, then say you would under the normal CGT rules, which adopted, the higher versus cost base versus 1988 timeframe. So, we kind of feel that we've now got this third style of CGT. We had the 88 rules, we had the 2017 deferred tax liability for the transfer balance cap, and now we've got a different approach for Div 296, and that's slightly problematic in that sense, but it's the all or nothing piece as well that's problematic. Now, funds can also, even if they're not in scope for Div 296, funds can also make the election now or by the due date for funds that they potentially think will be in scope. So there'll be a sort of a balancing act to determine whether or not it's appropriate to apply the CGT adjustment. Doesn't apply to indirect assets. So wraps are different, but if you're investing through a unit trust, it's only applicable to the units in the unit trust, not the underlying assets. So if you've got properties or whatever inside that unit trust, it's not a fixing the cost base of the property. It's fixing a cost base of the units at that point. So you've got to be mindful of how that's going to work. But this is a bit of clunky administration that's going to be thrown on top of all the other additional clunky administration pieces that we need to contemplate in this space, and means effectively we're maintaining two sets of records here. But if you use an example, really what I want to touch on here with this example of James is something that was identified clearly when the original legislation came in, and there was all pushback about unrealized gains, right? One of the big pushback items was obviously we don't have the liquidity, right? The counter argument was paying tax on unrealized gains as you go, means that you're balancing out or you're distributing that tax liability over a longer period of time. The offset of that is versus having the liquidity to pay the liability. So what you'll notice in this example of James, who held a property, value of the property at $2.8 million at the 30th of June. His member balance was over the $3 million, and we've made some assumptions around income and growth. And so when we look at it, and if we measure James's situation under the old measure versus the new measure, we'll see under the old Div 296 that it was a far more sort of equal distribution of Div 296 tax liability across the 4-year period, noting that he sells the asset in the 29-30 year. In selling the asset in the 29-30 year, the Div 296 liability for James jumps up dramatically, and indeed he actually pays a little bit more, a bit more Div 296 tax overall, but he's then got the liquidity to pay it. So it's something that we have to prepare clients for, is to say, to get the tax outcomes that the industry wanted with regards to taking away this measure of taxing unrealized gains, it may result in a higher tax liability, but you're going to have the liquidity to pay it. So it's just one of those areas that I think when we're planning and when we're looking at these sorts of things, noting that ECPI and that are irrelevant to Div 296, the conversation piece over the next the next 5 months and then the following 12 months is really going to be around what is our future CGT position likely to look like for our clients. And so, what I've sort of tried to address is say, well, there are fundamentally three stages for this. There is the pre-30 June stage, where we're looking at the investments from a CGT point of view, almost exclusively. We might be looking at our strategies, whether we want to make contributions in, start to draw down some additional benefits if that's our case. And let's be very clear that it's going to be very much fund driven as to whether it's better to have money inside or outside super. And having money inside super is fundamentally still going to be very tax effective for the vast majority of people. It's going to often depend on what other sorts of structures they've got outside of it. So we have to factor that in there. We'll then have our transitional year, which is up to 30 June 2027, where we have to look at our CGT election, get them done. We appreciate the assessments at the end of the year. So is that the time to sell down? Is that the time to withdraw money? That is effectively our 1 year when we can do it, because once we move past the 1st of July 2027, then we're locked in, right? And we're locked in to opening versus closing balance. We're locked into the irrelevancy of withdrawal strategies, the irrelevancy of asset values and things like that with regards to being able to do anything about it. We're into the system completely, and that becomes something that we need to be mindful of. So I want to just, I've got an offer that I want to talk to you about briefly in a moment, but I just wanted to highlight a couple of key things that exist with the legislation. Insurance proceeds. Still terrific that we've got the exclusion for structured settlement individuals. The problem is when the terminology they use around structured settlement is that that money is being used to assist in the funding of ongoing medical and care expenses, right? So is TPD, right? And TPD is still included, so there's no carve out for TPD proceeds. So that's always been troubling. The indexation piece, nice to have it, right? The ugly part of it is the method. Couldn't we have looked at a simpler method? And I know I'm looking in the past now, but couldn't we looked at a different method with reference to, say, the contribution caps, where the NCC is 4 times the CC? Couldn't we have just looked at it that this threshold is X number of times that threshold, and kept it quite simple in that regard? CGT, the admin burden associated with having to track those cost-based adjustments there, and similarly with the ECPI side of things, and doing 2 separate ECPI calculations is problematic. And the death benefit with the carve out is a positive, right? So that's really good. However, we are bringing forward the liability in the instance of reversionary pensions, so it's something for us to contemplate. But further, it just adds to the potential of death benefits and death benefit tax, because if we've got non-tax dependents, then we might have CGT from a fund point of view. We might have Div 296 from the on the deceased member's point of view, and then we've got potentially PAYG on the death benefit to non-dependents as well. So there's multiple elements and layers that we have to factor in to that situation. So look, before I summarize, I just wanted to really quickly give you a quick overview, because that was a real quick sort of run through of the Div 296 stuff. What are we doing at Smarter SMSF? We've creating a Div 296 tax hub. We're launching that. It's pretty close to mid-Feb already, but I know that Aaron's working fairly hard on that in the background, and I'm giving you some input as we go along about helping people associated with this. But importantly, as you can see, there's a lot of stuff that's happened and a lot of stuff that we're talking about in today's session that is really broad brush approach. We've got our SMSF Day coming up around the country. We start on the 17th of March in Brisbane, finish on the 31st in Sydney, and we've got the major capitals in and around there. Basically, we've got 2 sessions of that, so approximately 3 hours dedicated to Div 296 with regards to our case study that we apply with our SMSF Day. So what we wanted to do, because this was a fairly full-on exercise today, was I wanted to provide you with effectively an extension of our existing early bird. So we have an early bird offering which runs out over this weekend, but we wanted to extend that for those of you attending today, if you wanted to attend our SMSF day, it's a great day. I mean, I do a lot of talking, but it's a great day from a CPD point of view. It's a great day from sharing knowledge point of view, and really that deep dive piece. So we wanted to provide that offer. So we're extending the early bird to the 18th of Feb. You just need to use that code that we've created specifically for today, SD26SG. It's important. I know you're speaking to Josh also that SuperGuardian have done some work on Hive on their hub there with regards to the implementation of clients around the 3 million and the 10 million. So again, everybody's doing what they can to help people out in regards to this space. So look, just to summarise, some key issues have been fixed from our original drafting point, and that's great. You know, the unrealised capital gains but tax, the indexation of the threshold, both significant pieces. There's a lot that we need to contemplate around death benefits and understanding the ramifications of those death benefits to our clients. So it's key to be mindful about that. And clearly, the CGT stuff is an area that people need to take into consideration with what they do moving forward. So thank you for attending today. We've got coming up, and so I've kind of drafted indexation as our next subject matter because we've got some key numbers being indexed for the 26-27 year. So I've factored that in for March, and then as a flow on from that, I've looked at reviewing SMSF contribution strategies in our April webinar. But as I highlighted at the beginning, Josh and I have been talking about whether we run a second Div 296 once we have some regulations around some of the actuarial stuff and other requirements. So we'll keep a close eye on that. But again, if you've got any situations or if you've got any desire to have some Div 296 presentations done for you, then please reach out to SuperGuardian or to ourselves at Smarter, and we can hopefully help you out there. So thank you for attending. I hope you got some information. The slides and that will be sent out to you, as is always the case with your CPD. If I don't see you at the SMSF National Conference in Adelaide or anywhere else along the way, then I look forward to you joining me at our next webinar. And thank you all for your attendance. Bye for now. Let me just stop the recording.